Welcome to the Investing Mastermind Podcast. I'm Michelle Markey.
And I'm Sina Lundholt.
And today we're continuing our series on Warren Buffett and Charlie Munger's 4 principles of investing. In our last episode, we covered the first area of circle of competence, of asking ourselves if we're capable of understanding a company and the business they do. And today we're going to focus on management. So we're mainly going to talk about the chief executive officer's role and expectations with what the CEO is supposed to do, but also as part of management are the board of directors, which choose the CEO because the shareholders vote in the board of directors. And then also there's other members of the executive management team, but we're just mainly going to talk about the CEO and what metrics we can use to evaluate how well of a performance the CEO is putting on for the benefit of the company. Like, are they helping the company to grow in the right direction? And can we trust and believe the CEO? Because a lot of people think and know that the number one job of a CEO is to be the best salesman of the company, which happens a lot of the time. But another role that maybe doesn't get as much attention is the role of being a capital allocator. And what that means is you decide how you want to allocate resources of people and money toward certain decisions of how the company is supposed to grow in the future. So by, say, allocating capital toward certain growth initiatives, the CEO is making a decision about how they believe the company will live up to its mission and values by having money be used for certain initiatives. So that is a tremendous area that we're going to discuss in more detail today. And one of the ways in which a CEO might also decide how they're using capital specifically is if they're using the cash generated from the business, or if they're going to go out and borrow money and have short-term or long-term debt added to the books in order to fund their initiatives or payroll or other things going on at the company. So Sina is actually going to expand on why looking at debt and certain kinds of debt is especially important when we're looking at the CEO's job and performance.
Yeah, that's true. And before I go ahead and talk about debt, I'm also talking into my checklist that we started working on. If you're in the gym or in the car right now, you can easily listen to this episode, but you might want to come back and take some notes and write down some stuff at a later time when you're in front of a computer, because you'll get some nuggets of wisdom here. So to go back, what we want to ensure is that management have integrity and allocate capital, as Michelle mentioned. And we want to have the CEO think about the shareholders when they allocate the capital. We want to ensure that they keep us as shareholders in mind and invest in growth initiatives for the long term. So have a long-term strategy. And one way to check if the CEO is a great manager is to research if the company has any debt. Are they borrowing money to fund the business? And we're specifically interested in the long-term debt of the business. If you want to check that the company has little to no long-term debt, you can easily find that number on, for example, Yahoo Finance or on stockanalysis.com. What is interesting for us is how long would it take management to actually pay this debt off? And we can do that by dividing the long-term debt with the company's free cash flow. And that number will give you the number of years management will take to pay off the debt. For us as value investors, and especially for me, I don't really want to see a whole lot of debt. I prefer less than 2 years of long-term debt, but I'm also super ultra conservative. I know that, for example, Phil Towns says 3 years of debt.
Right. And just to expand on what you're saying there is, like, you want to be able to see that the amount of free cash flow that the company can generate can pay off that long-term debt within 2 to 3 years. So if you see, like, say, long-term debt is $15 billion, is the company generating on average $5 to $7 billion per year in free cash flows to be able to pay off that $15 billion of long-term debt? So you tend to not be as worried about short-term debt because that can be more paid off within a shorter amount of time with the cash the company generates within the year. But that's what Sina is talking about, is you don't want a company so heavily loaded with debt, because that can really hinder the company's forward progress, and it can just be a snowball of bad situations to be in, especially if the interest rates on corporate debt were to go up like they're probably doing now. So there's probably a lot of companies that are kind of questioning, we shouldn't take on debt at higher levels of interest rates, because I don't know if they'll be able to fully pay it off. So they want to be careful about, they load up on debt when the interest rate is cheaper, and then that helps fuel some booms like we've seen in the last couple of years. But now we can see them paring back on the debt because it's a little bit less tenable when the interest rate is higher. Just like all of us consumers, like the higher our mortgage rate is or credit card interest rates are, like the APY, we don't like that because it means we're paying way more in interest than we probably want to. So it's the same thing with management. You want to be on the lookout for that.
Yeah, and so one more thing you of course need to look into is if they're taking on more debt over time, or if they're paying off debt. And you can see that by, again, tracking back in time on Yahoo Finance, for example. Some websites even have like a visual of if the debt is growing or if they're actually paying it off. And we prefer to see that they're paying it off. So again, I prefer that they don't take on long-term debt, that it should take less than 2 years. As Michelle mentioned, the reason why it is so important is that if the business have debt in times of prosperity, then it might be a real problem, like now when interest rates are going up and they have to pay a higher interest rate. When times are tough, that debt can be a super heavy weight. And what we see is that debt is a reason that a company goes bankrupt, because they simply cannot pay off the debt. So it's definitely one of the most important things to actually track. And if they don't have any debt, then you can move on to the next step in the checklist. But if they do have a lot of debt, it's actually time to stop investigating this company and maybe put it on hold to check up on later. I have that with one company that had a lot of debt, and they were paying it off, and they had the ambition of paying it off, is what they wrote in the annual report. So I kept track on that. So as soon as that company goes on sale, I might actually want to scoop up that business. So that's something, you can also read in the annual report, what is the plan about that debt? Why did they take it on in the first place? And what is the plan to pay it off? Is it something that the management is focused on, or is it something that they aren't focused on? The next thing on the checklist under management is that the company's return on invested capital is higher than 10%. So return on invested capital is also called ROIC. And this is just one of those fancy terms that the financial world like to call things. So for example, with ROIC, it's an indicator of how well management have made profitable investments in the past. And we would like to see an ROIC above 10%. It comes from actually Warren Buffett, who many years ago mentioned that he wanted to see an ROE above 10%. ROE is different than ROIC. ROE is return on equity. However, that number can easily be manipulated to look higher, because if the company takes on the famous long-term debt, then the ROIE will look really good. But then when you compare it with the ROIC, if the number is the same, then the company does not have any debt. If the company has debt, then ROE is higher than the percentage we see in ROIC.
Yeah, and just to expand on that, when we look at ROIC, it's a combination of making sure we're aware of both the equity and the debt or leverage that a company is using to try to grow the business. So it's a more honest metric, because you are fully compensating for the fact that sometimes the business isn't just using the cash or the existing equity of the company to build out their business, but by incorporating the amount of debt into that equation, and you divide that out by over the total capital base. So existing equity plus leverage over the capital base, then you get the total return of finding out how well your deployment of capital ended up being.
Yeah, and it might sound very complicated, ROIC and ROE, but actually you can find the numbers online. For example, on the website stockanalysis.com under statistics, you can find ROIC and ROE. You can find that number everywhere. So it's actually not that difficult to find the number. You just need to understand what it means, and you also need to be able to actually track it back in time. So for example, on gurufocus.com, you can track it back 4 years. If you buy their version, you can track it back even longer. On Stock Analysis, it only shows the most recent number, so you would have to find the number elsewhere. For internationals, there are certain websites out there that actually also have the number, but it's just the financial world who really likes to make words seem really, really difficult. But for us, the reason why it is so important is because Warren Buffett mentioned that he likes an ROE larger than 10%. And as new investors, we want to make sure that the debt is not making it look like the ROE is fantastic. So that's why we want to also check in with the ROIC.
Yeah. And if you can find some longer term data, like I know we talked about how Guru Focus shows the last 4 years plus like the latest trailing 12 months, and that's helpful, but it might not give you the full picture. So even though you could be seeing it there, it would be helpful if you can find sources of longer term data, like going back 10, 15, 20 years. And what you could do is if you don't see it on some of these websites for free, you could also calculate it yourself, and you can compare and contrast the different formulas that different sites use, because it might not be exactly the same. But you could figure it out yourself by looking at the historical annual reports known as 10Ks, and you pull out that long-term debt and also the free cash flows, and you try to figure out based on different formulas what might be the return on invested capital. So like definitely look into some of those reports if you want to get the more long-term history to give you a better picture, because it could have been going up and down. Like sometimes it's not just a straight direction, up and to the right. Sometimes it's a little bit going down because there was something that happened to the company, like maybe some kind of event or crisis. So it's going down a little bit, or maybe they changed the CEO and then it's going back up when things change. So you want to monitor that the ROIC is generally trending in a positive direction if possible. And if it's not, you can maybe find that as an opportunity to see, okay, they went through a bad event. It went down for a couple of years, but now because they made these changes, I believe it's going to go up. So maybe it's a good idea to invest in the company if you think that they're on the mend in that way.
Yeah, and that information you can find in the company's annual report there. That's where they write about all the ups and downs and what happened to the business that year. And it might sound like a daunting task to open an annual report. Is that super difficult? But it actually shouldn't be. It should be easy to read. And if it's not easy to read, if it's really, really difficult language, then it might be management that's trying to hide something. Most annual reports are not that difficult to read. So talking about that annual report, we have now reached number 3, the last point under management in the checklist. And that says, I have studied the CEO, the board, and executive management, and I trust the CEO to behave with integrity. As I mentioned before, it's super important to track managers like the CEO. This person could be the founder of the company. It could be a person that the board hired, but the CEO is really a key person here, and we want to check up on this person's character. So what you could look up is this person the founder of the company, or did they grow within the business? Did they come from outside? What was their past career path like? Are there any articles or other material describing this executive officer in previous roles or in the current role? And also one thing I like to do, because management is actually one of my favorite topics to investigate. There's so much good stuff in this. So one thing you can also do is you can look up on glassdoor.com to see what employees says about this person. So that's some ways that you can find out if management have integrity. There might be YouTube clips or other media appearances. There's these earnings calls in connection with the quarterly reports where you can listen in on what the management says about the business in the last quarter or in the last year, and usually find that in the investor relations section on the company's website. So it's, you hear the CEO's voice. I follow a lot of my favorite CEOs on LinkedIn. There's also some CEOs that have social media profiles. What you need to know is oftentimes they have communications director that's posting on their behalf. So it's not always necessarily the CEO that does all the work, but there are some CEOs where you can clearly see that it's actually them that's posting, or maybe it's some communication director, but it's definitely a topic that the CEO is very passionate about. Another person you want to track is the CFO, the Chief Financial Officer. We definitely want a person in that role that has a lot of integrity, because we don't want someone who manipulates the books in a serious way, because they are the company's main bookkeeper. So what has been written about that person in the past? Do some research on Google to find out about that person.
And in addition, you can also evaluate the CEO and CFO based on some of their capital allocation tendencies, like, are they buying back shares when the stock price is kind of high? Because sometimes they might be buying back shares at too much of a price compared to what the intrinsic value is of the company. And then that could be not such a good reflection of the CEO and CFO, in that maybe their judgment is somewhat biased, and it would be better if they waited to buy back shares of the company, which means the company is retiring shares, which means the remaining shareholders own a bigger part of the corporate pie, which is technically a good thing if you can buy back the shares at a discount to what the company is really worth. So some people who have been really good at doing that are people like Warren Buffett in buying back Berkshire Hathaway shares. And Warren Buffett has also praised Tim Cook, the CEO of Apple, for buying back shares in a prudent way. And in addition to buying back shares as a reflection of if the CEO and CFO are making the right capital allocation moves, you can also check to see if the corporate insiders actually own the stock. So one criticism of, say, Twitter was that a lot of the executive management team or board of directors did not really own that much of Twitter itself. So some of their capital allocation decisions may not have necessarily been reflecting, say, actual shareholders who own a lot of the company. So when you see that sometimes of a mismatch between, are the corporate insiders behaving in such a way as if they were the shareholders, like they put themselves in the shareholders' shoes, because shareholders are not just people who own pieces of paper, they're actually the business owner. So as much as, even if we only own one share, we are a business owner of a company. So it doesn't take away from how important our ownership of the company is. So you want to look out for that too. And there's many websites of like Insider Monkey or Insider Cow, so many like insider like websites where you can look up how much do CEOs or other executive members own some of the company. And to me, that's a big measure of, like, if the CEO is buying their shares just for their own account, that's kind of bullish for the company, because the CEO is saying, I believe in this company. But as we've seen in the last couple of years, there's been a lot of CEOs that have been selling a lot of shares, and sometimes it's just part of their compensation, so it's not a big deal. And other times they're selling a lot of shares. So maybe they know something that is about to happen to the company that could be not so good for the future of the company. So if you believe in the long-term future of the company, ideally, you don't really want to see the CEO and the top leader selling too many shares, because that's a bad sign. So a couple of other, fun tidbits for people to look into and figure out if the CEO is behaving in a way that's aligned with shareholder values. And another point I want to make about how we study the CEO in terms of if they have integrity and also talent, which are we've been talking about all ways that you can assess their integrity and talent today as the main principle about management. And one way you can also do that is by reading and judging the CEO's shareholder letter. And sometimes they come out on an annual basis. Sometimes a letter to shareholders comes out on a quarterly basis, like Netflix's CEOs did that. And you can also judge how well you think the CEO is being honest with you. So this was actually a concept that the author Laura Rittenhouse covered in extensive detail in her book, Investing Between the Lines. So you could check out that book and look at guidelines of how you evaluate and judge a CEO's letter and figure out, do they have candor, which means the extent of being frank with the person who's reading it. And one really great example of someone who usually exhibits a lot of candor is Warren Buffett himself. So if you read his letters and you compare the Berkshire Hathaway annual letters to other people's letters, you can see that Buffett has a lot of candor, and you can see how well other CEOs are living up to that level of candor, of how honest you feel like they're being with you. And also you can check back and see, like, they made certain promises in prior letters. Did those promises come true? So you could measure that in terms of like the news or the annual reports where they talked about things that they were going to do before, and you can follow up with them and see, did they actually do what they were going to say they were going to do? So making sure the action follows talk is a measure of integrity you want to check out.
Yeah, absolutely. I've actually experienced that in an annual report, a CEO wrote about their strategy, their goals for the future, but then didn't keep us updated on what actually happened. And then all of a sudden, a new goal was introduced a few years later, where it was like, okay, but what happened to the old goal, and how come there was a new goal introduced ahead of time? Where if that's not transparent, then I'm definitely not necessarily trusting that this CEO has integrity. I've also seen the opposite, where there's been great tracking on performance, on strategy, where it's like, wow, this is amazing. We can see, when they failed, because everybody fails at times. So if they're open about that and actually describe, this is what happened, this is what we've learned, that's really amazing. So that's how you check an annual report. An absolute key number to check is the profitability of the company. So you want to check if a company had a profit or a loss, and you do that by looking in the annual report, and you find the income statement. At the bottom of that statement, you'll find the company's, usually it's the net income, but it could also be the net loss. And if it's a loss, it's typically in a bracket or it has a minus in front of it, and it will say loss. Sometimes they find other words to kind of cover up that they had a loss, but since we're looking for healthy businesses, we want to see a profit. And that's different from a lot of other stock investors. If you're a technical analyst, then you don't necessarily look for this profit or loss. Or if you're a day trader and are looking at other indicators, then you're not necessarily interested in the health of the business. But for us who wants to, first of all, not lose money and also see our money grow over the years, is something that's super important to us, that the company comes out with a profit. And if they don't have a profit, that it's clearly described, maybe even ahead of time, that the company will go through some difficult years transitioning into something new and innovative, not disruptive, but new and innovative, that it would actually cost some money, so that they will come out with a loss. So that's really, really important to also describe.
Yeah, and one example I think of what you're talking about is, some companies, especially in tech, might at first glance seem unprofitable because, they just seem like they have net losses all the time. But then you should maybe look at the R&D, the research and development spending, and see, actually they're not losing money. They're just allocating it to continuing innovation, to what you just said. So those kinds of things, you have to look at the nuance of, you don't just read the annual reports and the income statement or balance sheet as black and white, because there could be more to the story and you have to give yourself context. So I hope that also helps to, try to figure out where the money is going, that You try to add the story of what these figures are telling you.
Yeah, that's a really great point, Michelle. And with that, the show has come to an end for now. We'll be back on Tuesday. Until then, have a great time.
Till next time.
If you enjoyed the show and found the content informational, we would be super grateful if you would leave us a review and follow us wherever you get your podcasts so you automatically get new episodes in your feed. We publish a new show every Tuesday.
The contents of the Investing Mastermind podcast are for educational, informational, and entertainment purposes only. None of this is investing advice, and if you need help in your personal situation, please consult with a professional.